At this exact moment, we are sitting inside one of the rarest financial windows in modern history. Not a trend, not a rumor, a pattern that has repeated itself multiple times over the past century. And every single time it showed up, a wave of completely ordinary people, teachers, truck drivers, nurses, small business owners, walked away with life-changing wealth. And then the window closed. And the people who hesitated, who waited for more certainty, who said maybe next month, were left standing outside wondering how they missed it again. I know that sounds like hype. I know you've probably heard something like this before and it turned out to be nothing. So here's what I want to do in this video. I want to show you the actual historical pattern and walk you through what happened the last few times this setup appeared. I want to show you who got rich from it and why, and then I want to show you exactly why I believe we are inside that same setup right now in 2026. No fluff, no get-rich-quick nonsense, just the pattern, the evidence, and what it means for you. Let's start at the beginning. There is a concept in economics and market history that serious investors quietly study but rarely talk about in public. It's the idea that wealth doesn't distribute evenly over time, but instead concentrates in very specific windows where conditions align for rapid and broad money creation. Outside of those windows, the game is much harder. Wealth tends to stay where it already is. The rich get richer, the middle class treads water, and the poor fall further behind in a slow, grinding redistribution upward. But inside those windows, something unusual happens. The playing field temporarily tilts in favor of the person who is paying attention, even if they're starting with almost nothing. These windows don't appear randomly. They follow disruption, whether technological, monetary, or structural economic disruption, reshaping the rules of the system. During the transition period, before the new order is fully established, there are enormous inefficiencies in the market. Prices are mispriced. Opportunities are overlooked. The old guard is slow to adapt to what is unfolding in real time. And the person who spots the pattern early and moves with conviction can capture gains that would normally be impossible in stable environments. Let me show you exactly what I mean by walking you through previous moments when this pattern showed up clearly. Go back to the early 1990s. The internet was not what it is today, and it was barely something most people had even heard of. A handful of researchers used it. A few tech enthusiasts were excited about it. The financial establishment mostly dismissed it as a curiosity. But a small number of people looked at what was happening and said this changes everything about communication, commerce, and information. The ones who acted on that belief, who started companies or bought stock in early internet businesses, created staggering amounts of wealth. Amazon went from a startup to one of the most valuable companies on earth, and Google became a verb embedded in everyday language. Ordinary people who bought early and held were turning a few $1,000s into hundreds of thousands, sometimes even millions over time. Now here's the critical thing I want you to understand about that period of explosive wealth creation. The people who got rich from the internet boom were not mostly geniuses or insiders with elite credentials and advanced degrees. Many of them were simply people who recognized the pattern early enough and positioned themselves before the broader public caught on. The key was not intelligence, it was timing and conviction in the face of skepticism. Then that window closed. The dot-com bubble burst, and many people lost money in the violent correction that followed. The easy gains were gone, and for the next several years, the wealth creation window narrowed dramatically. Fast forward to 2009. We had just come out of the worst financial crisis since the Great Depression. The housing market had collapsed. Major banks were failing or being bailed out. Unemployment was soaring. And the stock market had been cut nearly in half. The mood was pure fear. And this is a crucial part of the pattern I want you to lock into your memory. Wealth creation windows almost always open at moments of maximum fear and confusion, not at moments of optimism and celebration. When there is maximum fear, assets are priced for disaster. They reflect the worst possible outcomes that people can imagine. And when the world does not actually end, when things stabilize and then recover, the gap between fear pricing and reality produces enormous returns. The people who bought broad stock market index funds in 2009 or real estate in 2010 and 2011 saw extraordinary gains over the following decade. Many of those individuals doubled, tripled, or even quintupled their money, not because they were lucky, but because they moved when others froze. And then there was Bitcoin, another example of a wealth window hiding in plain sight. In 2011, Bitcoin was worth less than $1. In 2013, it was still under $100. By 2017, it crossed $20,000 for the first time, creating life-changing returns for early believers. The people who bought it at 50 cents or $5 were not crypto geniuses with secret knowledge. Most were simply curious individuals who believed in the possibility and invested money they could afford to risk. Some of them saw returns that were almost incomprehensible, where $1,000 became $1 million over several years. These are not exaggerations. They are documented, verifiable outcomes that followed the same disruption pattern. But not everyone who invested in Bitcoin made money, and this part matters just as much as the upside stories. Many people bought at the top of various cycles and sold at the bottom in moments of panic. The pattern rewards early movers, not everyone who participates after the crowd has already arrived. Timing matters enormously, and that brings me back to where we are right now. Because what I see happening in 2026 looks remarkably similar to those earlier inflection points. We are experiencing multiple major disruptions simultaneously across technology, money, and physical assets. Historically, when disruptions stack on top of each other, the wealth creation window becomes wider and the gains become larger. Let me break down what is actually happening right now so you can see the structure clearly. First, artificial intelligence is moving from hype to real-world deployment at an accelerating pace. We are no longer in the purely speculative phase. We have crossed into the application and monetization phase. The money is now being made by people who are figuring out how to use AI to build businesses and generate assets. This mirrors the mid-1990s internet moment, not the early theoretical stage and not the late bubble stage. The people who built around the internet in 1995 and 1996 were neither too early nor too late. They were inside the window. I believe we are in that exact window for AI right now. Second, the monetary system itself is undergoing structural transformation at a global level. The relationship between governments, central banks, and digital assets is shifting in ways not seen since the early 1970s. Multiple countries are now holding Bitcoin on their balance sheets, and strategic reserves are no longer fringe ideas. Institutional investors who once dismissed cryptocurrency are now allocating meaningful portions of their portfolios to it. The infrastructure has been built, regulatory clarity is developing, and institutional adoption may still be in early stages. Third, the real estate market is undergoing a structural shift driven by permanent changes in work patterns. Remote work has altered where people want to live and what they are willing to pay for location. Markets that were overlooked for decades are becoming attractive, while others once seen as untouchable are softening. The person who understands this shift and buys in the right markets before the consensus catches up may see significant gains. Now, I want to address something directly, because I know some of you are thinking it right now. You're thinking that these opportunities sound great for people who already have money to deploy. But what about someone starting with very little, earning a normal income and managing ordinary expenses? This is one of the most important parts of the historical pattern that often gets overlooked. A surprising number of people who benefited from previous windows started with very little capital. During disruption, the advantages of incumbents are temporarily weakened and existing structures become liabilities. The big banks, major corporations, and wealthy families are optimized for the old world that is fading. When the new world arrives, that optimization slows them down while newcomers remain flexible and hungry. The person with nothing to protect and everything to gain can have a structural advantage during transition periods. Think about the early social media era between 2006 and 2008. A random person with a camera and an interesting idea could build an audience of millions. Major media companies had enormous resources but could not adapt quickly enough to the new medium. Meanwhile, ordinary individuals were becoming global media brands with substantial income streams. That window eventually closed as platforms saturated and algorithms began favoring established accounts. Today, it is extremely difficult to build that kind of audience from scratch. But for a period of years, the opportunity was wide open for those who acted early. The AI window is wide open right now. The crypto window, while narrower than in 2012, still offers opportunity. The real estate window in specific markets remains open as structural shifts continue to play out. The question is not whether these opportunities exist in 2026. The question is whether you will act on them before they close. Let me give you the psychological reason why most people don't act, because this is where an advanced understanding of human behavior becomes critically important. There's a concept in behavioral psychology called loss aversion, and it explains much of the hesitation you see around disruptive opportunities. Human beings feel the pain of potential loss roughly twice as strongly as they feel the pleasure of equivalent gain. What this means practically is that when you see an opportunity, your brain immediately generates a vivid picture of the worst-case scenario. You lose the money, you look foolish, you made the wrong call, and that imagined pain feels intensely real. That imagined loss feels much stronger than the imagined pleasure of success, so most people freeze instead of acting. They wait. They say, "Let me watch this for a little longer before I commit." And while they're watching and waiting for more certainty, the window moves without them. There's also something called social proof bias, and this one is just as powerful. Human beings are tribal creatures, and we feel safest doing what the people around us are doing. When the people around you are nervous, it feels dangerous to be bold. When they're excited, it feels safe to participate. But here's the brutal truth. By the time everyone around you is excited about an opportunity, you're usually near the end of the easy gains. The people who got rich from Bitcoin were mostly not people who bought it when the New York Times was writing positive feature stories about it. They bought it when most people still thought it was either illegal, a scam, or a toy for weird internet people. The discomfort of going against the crowd is a feature of the early window, not a bug. That discomfort is actually evidence that you're early and positioned ahead of consensus. Now I want to talk about what separates the people who capture these windows from the people who watch them pass by. I've seen this up close and studied it deeply, and there are a few key differences that show up every single time. The first difference is education over speculation, and this is non-negotiable. The people who make real money during disruption periods are not gamblers. They are students of the asset and the underlying system. They spend enormous amounts of time genuinely understanding what they're investing in and why it matters. They understand what Bitcoin actually is and how it actually works, not just that the price went up dramatically. They understand what AI can and cannot do, and why specific real estate markets may appreciate based on real drivers. This understanding gives them conviction, and conviction allows you to hold through the volatility that inevitably comes with early positions. The second difference is asymmetric positioning, which is a strategic way of managing both risk and upside. Smart early investors do not bet their entire life savings on a single disruptive opportunity. They allocate a portion of their capital, often relatively small, to positions that have asymmetric potential. Asymmetric means the downside is limited, but the upside is theoretically very large compared to the risk. If you put 5% of your savings into an early stage opportunity and it goes to zero, you've lost 5%. But if it goes up 10 times, your total portfolio increases by 50% without ever risking everything. You don't need to bet big to win big if you position early enough with the right structure. The third difference is patience combined with decisive action, and this pairing is misunderstood by most people. The action comes first. You do the research, form conviction, and make the allocation deliberately. Then the patience comes. You hold through the noise and inevitable drawdowns without panicking. You don't panic sell when the price drops 30%, and you don't sell too early out of fear. Most people reverse this process. They act impulsively based on emotion and are patient about doing research later. It should be the opposite. Research patiently, act deliberately, then remain disciplined. Now let me get specific about what I actually think you should be looking at right now in 2026. On the AI side, the opportunity is not primarily in buying shares of giant AI companies. Those are already priced for a significant amount of future success and widespread adoption. The opportunity is in learning to use AI tools to build genuine income-producing activities. People developing real skills in AI-assisted content creation, software development, marketing, and copywriting are monetizing in ways impossible 3 years ago. The barrier to entry for running a competitive small business has collapsed dramatically. One person with AI tools can now produce what previously required a team of 5 or 10 people. This is the window. The skills are acquirable, the market is still learning, and early movers are capturing disproportionate market share. On the crypto side, I want to be careful because this is where emotional decisions often cause damage. The macro setup for Bitcoin specifically, not the broader speculative crypto market, has never been stronger. Institutional ownership is increasing, government adoption is accelerating, and fixed supply creates structural scarcity. In a world where governments are printing money to manage debt loads, that supply constraint creates powerful demand tension. But please hear this clearly. This is a volatile asset, and the path will include dramatic corrections. The strategy that has historically worked is not timing the market perfectly, but timing the market with a manageable position size. On the real estate side, the opportunity lies in markets being repriced due to migration patterns triggered by remote work. There are mid-sized cities where median incomes among new residents are rising faster than housing prices are adjusting. The gap between current prices and fundamental value, based on income inflows, represents a classic early window opportunity. This is not everywhere. You need to research specific markets and identify the real drivers behind the numbers. But the pattern is there for the person willing to look carefully and act with intention. I also want to address the mindset shift required to actually participate in these windows. Most of us grew up in a financial culture that emphasized safety above everything else. Save money, avoid debt, don't take risks, contribute to your retirement account and move slowly. These are not bad pieces of advice. They are reasonable defaults for stable historical periods, but they are defaults designed for stability, not for disruption windows like the one we're in now. In a disruption window, the greatest risk is often not taking enough risk. The cost of losing some money is frequently lower than the cost of sitting out entirely. A stock market index fund delivering 7 to 10% annually is wonderful, but it likely will not change your life. It will not allow you to leapfrog the wealth tier you were born into. The opportunities inside a genuine disruption window, when approached with education and disciplined sizing, have historically delivered life-changing returns. And right now, I believe we are inside one of those rare windows. Here's something critical. These windows feel ordinary from the inside while you're living through them. In 1995, the early internet era felt confusing and uncertain, filled with skeptics and failed experiments. In 2013, Bitcoin felt like a strange bet with unknown odds, not the foundation of a revolution. The windows never feel as clear and obvious in real time as they appear in hindsight. That's precisely why most people miss them and only recognize them after the fact. What makes the difference is developing historical pattern recognition and applying it even when conditions feel uncomfortable, and then having the courage, backed by genuine understanding, to act despite uncertainty. I've spent years studying these patterns and watching people around me capture these windows. I've also watched people hesitate, delay, wait for more certainty, and live with regret afterward. And I can tell you with real conviction that this moment has all the hallmarks of a genuine wealth creation window. The AI transition is real and still early. The monetary shift toward hard assets is accelerating. The real estate repricing in migration-driven markets is happening right now in plain sight. And the psychological barriers that stop people, fear, social pressure, loss aversion, will never disappear. You have to choose to act in spite of them because they are permanent features of human behavior. So what's the actual takeaway? What do I want you to do differently after watching this? 3 things. 1, spend the next 30 days becoming genuinely educated about one disruption area I've described. Not casually reading headlines, but actually studying the fundamentals through books, podcasts, and primary sources. Conviction comes from understanding, not from hype or social media momentum. 2, decide on your asymmetric allocation with complete honesty about your risk tolerance. What percentage of your savings could you allocate to a high-risk, high-potential position without financial ruin if it failed? For some people, that's 2%. For others, it's 10%. Know your number clearly. 3, set a specific date to act, because vague intentions rarely translate into real behavior. People who set specific implementation dates follow through at dramatically higher rates than those who delay. The window is open. The pattern is clear for anyone willing to examine history honestly. The only question is whether you'll look back in 5 years, remembering this as the moment you moved, or whether you'll look back wondering why you waited for certainty that never came. I genuinely believe you have the capacity to be in the first group, but belief without action changes nothing. If this video shifted your thinking even slightly, share it with someone who needs to hear it. The most valuable thing I can do with this platform is make sure these ideas reach people ready to act. Subscribe if you want to keep going deeper on these topics, because we're just getting started. The window is open. What are you going to do about it?